This is a City AM Studios production.
Hello and welcome back to Business as Usual, brought to you by Okta with me, Martin Kimber.
And me, Matt Kenyon. Coming up, a lifeline for the embattled Thames Water, but it could cost them £750 million.
Less than 2 months after declaring that its Mythos model was too powerful to be released to the public, Anthropic is set to release it to the public.
And our city editor, Simon Hunt, rages against digital banking apps. Find out why. Well, welcome back to the podcast. First off, we're going to be talking about 3 major recognisable British brands, all of whom are in a bit of trouble. And joining us to do this is the fount of all things FTSE, Michael Hunter.
Good morning.
Welcome back. Michael, how are you doing?
Very well, thank you. Thank you for having me.
Well, it's great to have you. First of all, let's talk Thames Water. I think it's one of relatively few firms in the UK that could be genuinely described as disgraced.
I think it's the most hated business in Britain.
Probably the most reviled, also one of the most crucial to our infrastructure, particularly London's infrastructure. They have been faced over the last year with some big disappointments in terms of a rescue plan, historically huge fines, and arguably it's swimming in as much debt as it is sewage. Now it looks set to pay £750 million, that's almost $1 billion, to get a rescue deal over the line. Michael, what is the latest?
Well, Thames Water, as you say, Matt, is certainly no stranger to the smelly stuff. It's been teetering on the brink of emergency nationalisation under a £20 billion debt pile for the last few years. That debt pile was established by previous owners who were loading debt onto the company secured against its assets at a time of low or in some ways almost zero interest rates. And since interest rates have normalised, it's been exposed to an increasing cost of servicing that debt to the point where it can't carry on, even though it has 16 million customers, all who've got to pay a water bill. Nobody can go anywhere else or not pay the bill. So the latest attempt from its creditors to avoid nationalisation involves that headline figure of nearly $1 billion, £750 million you mentioned. That's just fees over how they want to restructure the company to bankers and city services.
Wow.
And
doesn't touch the sides of the 20
just
billion.
to get it done. It's nothing to do with what would happen with those bonds. But what it would do, and where there is some hope for the embattled utility, is it would keep it out of public hands. Now, while there can be lots of debate about whether it should be nationalised or shouldn't be nationalised, people like Fergal Sharkey have criticised the water utilities, saying it's madness that they're not in public hands. It should never have been privatised by the Thatcher government in the late 80s and the 90s. Anyway, setting that debate aside, if you want to protect the taxpayer from having to get involved in this in some capacity, this latest attempt to throw the company over to its bondholders to put them in charge, which would wipe out the shareholders, by the way, who've been in this situation, that would protect the public purse from exposure to these kind of issues. So in that sense, from the perspective of the City of London and square mile investors, it is a way of preventing a nationalisation at the end of one of the most notorious privatisations of the previous era.
And what would come next?
Well, a stock market listing on the London Stock Exchange.
Which seems like a curious reward, because most times a company fails, they don't necessarily look at an IPO.
Exactly. But I think what it tells you, Matt, is that within all of this genuine scandal, I mean, there's nobody who can deny reasonably that this is a scandal. Within that scandal of irresponsible borrowing, a large Australian bank selling on the company once it had taken a lot of capital out of it via those debts, the stock market remains an extremely efficient mechanism of raising the money a business needs in order to operate. And if that means that is private capital which is doing that, that tends to be more efficient than public funds. And it's exactly what the city is for. So in this story of horror, the way a privatisation has gone wrong and the way a utility has failed to keep sewage out of the rivers and to stop the pipes from leaking as much, which are big failures, you do have a beacon of hope that the city's got another crack at getting this right properly without the taxpayer being on the hook.
And a less commonly heard opinion. So a friend of mine's husband, he buys and sells corporate debt for a living, which pays much better than journalism. And he was saying that, we keep talking about Thames Water bonds to be junk. But actually, they are still a monopoly. They do still have a monopoly on all these homes that have to buy water. They're not junk. And I think if they floated on the stock exchange, it probably would raise quite a bit of cash.
Well, for investors, from the perspective of investors, at a time when a company is going to be more properly run and regulators are more aware of what's happening, a water utility can provide a decent stream of income, no pun intended, to decent investors who are behaving responsibly. It's something which everybody needs. People are always going to need it regardless of however the economy is doing, and run in the right way and in the right hands, the market can have an efficient way of funding that, and also at the same time, crucially, making sure that the kind of infrastructure investment that's needed occurs at the same time.
And you mentioned the regulator there. They have a lot of blame to shoulder on this as well. I mean, if you cap the amount of money that you are allowed to invest in infrastructure, and then there's no money invested in infrastructure, then what do you expect to happen? Just very briefly, can you explain to people, why don't we just let it go bust?
I think letting it go bust is an option. It's still an option. It still could happen. And that's when the taxpayer would step in and resurrect the wreckage. But I think there's a question of confidence for London's consumers, for all of us who have to use Thames Water all the time. You don't want them to lose confidence in what's going on. And also, it can be very expensive to go bust. Lots of people get wiped out. The shareholders are already going to get wiped out in all of this. It's not a story where no one's on the hook.
But that's the market.
There is going to be a market response. The market has already spoken, as it were, in terms of what's happened. This way, there's less public money in danger, and the people who are the existing bondholders can take the company forward.
Very briefly, Michael, last year, WH Smith shed its high street stores, which were then renamed TG Jones. How's all that going?
Very badly. The high street stores have even been vandalised, at least one of them, with people crossing out TG Jones and writing in WH Smiths themselves.
Well, it's amazing. It does feel like it is the opposite of gentrification. Well, I was in a TG Jones store just before Christmas, and everything was already on sale, of like clearance. It didn't seem like it was closing down. It just felt like that was the new way things were in there. It felt really bleak. Probably the changeover only happened a few months before.
And even the high-performing shops at airports and railway stations are in trouble. The profit warning there today was so stark it pushed shares down almost 20% at one stage in
I think this is quite sad because when it was announced last year that Medela were going to buy the high street stores, which they were a trickier part of the business model, I remember thinking it was a really good idea. Just double down on airports and train stations. You can sell bottles of water for £3.50. It's a bit parasitic, but it makes money. They have chosen the 1 year in the last century where that is not a good business model. Yeah. It is such bad timing.
It's tricky. It's very tricky timing, but it's quite chunky profit warning as well. So the original range was between 90 and 105 million, and that earnings guidance has been slashed to 75 and 90 million. So that's a big downgrade.
One more thing, and it's just a third brand also facing a lot of uncertainty. Boots, they had been getting ready for a public listing, possibly on the London Stock Exchange, would have been a big boost for capital markets if it was to go ahead. It's not looking quite so hopeful anymore.
No, would have been an issue for bringing Boots back to the London market of about £7 billion. And now it looks like about a £7.5 billion sale instead. So again, it shows you that while there are some hopes, some companies wanting to get on to the London stock market, and it's an option for Thames, there are others where they can just simply raise more money elsewhere.
Boots was my work experience job at school for a week when I was 15.
I thought you were about to say it was your stock pick of the year.
No, I was fired. I was so bad. I was terrible. Anyway, thank you very much for coming in, Michael.
My pleasure.
Really appreciate that. Now, as Anthropic prepares to IPO, Anthropic was the company who said that its Mythos model was too powerful to be released to the public. Well, they're about to release it to the public. We'll be right back after this break.
This episode is brought to you by Okta. AI agents are everywhere now, quietly making decisions across organisations. That's great until you stop and think, who's in charge?
If you don't know who an agent is, what it's connected to, or what it's allowed to do, you can't really trust it to act in your interests. That's the bit Okta focuses on. They secure the identity of AI agents, one clear layer of control across the whole system.
Which means every agent has a clear identity, permissions, and a line of accountability, even as things scale.
Risk becomes something you manage, not guess at. Secure every agent, secure any agent. Okta secures AI.
Welcome back to Business as Usual.
Now, just under 2 months ago, the AI giant Anthropic told the public that its new Mythos model was so powerful that it would fundamentally threaten cybersecurity systems all over the world. But now, with a public listing on the horizon, Anthropic is set to release that model to the public after all. Joining us to discuss whether this is the end of days coming or not is our senior city reporter, Sam Norman. Sam, when they first said this is like a kind of, too dangerous to be released, I always thought that's just a bit of PR, isn't it?
Yeah, it's a great bit of PR.
Yeah. I mean, it's a great marketing spin, and we're almost at this point now where you can do something like this and it moves markets, which is crazy. Like, we've got to a point where Anthropic can come out. I have this tool. It's so good. I don't know if we can release it, and markets are like completely moved.
I mean, it better end the world now. 'Cause I think there should be some kind of retribution towards the company.
We have a podcast that is so powerful that if we released it, it's
Yeah,
not this one, it's the other one.
Yeah, This is our paywall podcast, which we just play to ourselves in the office.
I think what's interesting with this, though, so this release they've done now, this is actually a consumer Anthropic. So obviously the previous one was for businesses. And
They've given it a slightly less scary name.
Yeah, I think it's Fable.
Oh, that's softer.
Fable, so it's mythical.
Yeah, so
almost not real.
So they're going to release Fable with safeguards and user limitations, but they've still said, and I quote, "Releasing a model this capable comes with risks." Now, again, is this a bit of marketing? But I think it is interesting that consumers will actually get their hands on this. This is not just a business one. They're saying they're going to incorporate.
What are the safeguards that they have to stop us
they've
from
not been completely clear what it is. It's going to be more user limitations. So obviously the problem with the previous one with Mythos is it really had that ability to just scan and identify like these cyber risks, which is why we saw the Wall Street banks called in with the literal US government to discuss this.
But it's funny how that did feel like the moment where Anthropic, in the minds of a lot of investors, overtook OpenAI. It felt like that was the moment where it tipped, having not had as impressive for 2025.
The moment it was obvious that this is all spin is when they said, we cannot possibly let anyone see this. Oh, but we're going to license this to the banks.
We're seeing this interesting move now, though, where, and I know from the conversations I'm having, this is something like the Bank of England and the Treasury are actively talking about, but we know Anthropic have still not allowed UK banks to get their hands on Mythos, but this is where OpenAI is coming in, because the OpenAI version of this, which I don't know if this is too terrifying to release to the public, but OpenAI have said their version they're going to give to the UK banks. So it's sort of this weird competition, and you've got these very big egos at the top of all these AI companies. Obviously, it's Sam Altman, you've got Elon Musk at SpaceX. It's a very weird competition.
So far, what do we actually know about Mythos?
That it's too powerful for the general public.
We know nothing. We know absolutely nothing.
I guess that's the whole thing, that it can detect cyber risks on a level that has never been able to do before. But then, apply that to any other company, and they all say, I mean, B&M could drop a new food tomorrow and say this is got a flavor that you've never had before. But it's true. It's true. Just because it's AI, though, we approach it differently.
And is it going to do that thing where all these businesses are now realizing that all these tokens are costing so much money that actually it's cheaper to employ human beings in the first place?
From what I see in the banking sector as well, they are all doing that drawback as well, where HSBC's chief executive, George Salhedri, actually came out yesterday after warning that AI will destroy jobs. He's now come out and said, but we do still need human interaction. So you are all seeing this drawback. It's yes, obviously we need it, but we are seeing a little step back.
We have the head of LinkedIn UK as well this week telling our tech reporter basically that AI is less to blame for a lot of youth unemployment we're seeing than just things like business rates and our tax regime. But there is a question, though, as well about whether this has all just been timed with Anthropic's IPO. Because they have filed for one now. And this is, a couple of days later?
Yeah.
It's all quite convenient.
And between Anthropic, between SpaceX, and between OpenAI, all these, I guess you can call them stunts, in a sense. OpenAI came out the other day, and we know they're in the pipeline for an IPO too. They came out and said, actually, we're going to turn ChatGPT into a super app. Is these just all different pathways of marketing stunts ahead of this IPO to really strong that valuation? We know they all want to be the biggest one. It's no surprising the timing.
Well, Sam Norman, he may be too dangerous to release to the public.
And therefore we won't.
But
he's going to be trapped in the studio.
But he's about to leave the studio, so...
watch out.
Watch out. Thank you very much for
work
coming
from home
in.
today, everyone. And finally, in the space of about a decade, fintech firms have upended the UK banking market, and major blue chip players have had to up their game. You really can't get away with not having a half-decent banking app anymore. So 10 years on from the rise of Monzo, Starling, Revolut, and many others, are Brits really ready to go all in on neobanks?
Yes.
Martin. So, our city editor has a column on exactly this. Simon Hunt often joins us at the beginning of the programme, now joining us at the very end with a bit of your own opinion, frustrations, venting. I think you two might disagree on this front, but what has got you raging against the machine today.
I'm going full rant mode today, so forgive me for being grumpy, but I felt the time was right.
Gird your loins. Here we go.
Because up until now, I've been, I have, like many Londoners, I have warmly embraced the arrival of the digital banks. I have accounts with several digital banks, and
You have accounts with multiple different digital banks.
I do. And,
You just sort of holiday across them.
Exactly. And I mean, partly because I'm interested, partly for sort of journalistic reasons, that I feel as though in order to report on them, I'd have to use them. But also because they are, for the most part, pretty good. Except, as I've discovered more recently and using them more frequently, they are only good in a limited number of situations. And when they get into more uncommon or more difficult circumstances, suddenly they malfunction pretty speedily.
What sort of circumstances are we talking about here?
Who hurt you?
So I'm an equal opportunities ranter. So rather than pick on one, I've actually identified 3 different instances with 3 different apps in the past few weeks of where this has happened. So the first one was Revolut, when these random TfL transactions started popping up on my account, which I thought was suspicious. A, because I use an Oyster card. I don't use a banking account for any tube transactions. And B, because I wasn't in the UK at the time, and so I was pretty confident I hadn't recently
It's a locked door mystery.
And yet there was nothing on the app that flagged that it was a suspicious transaction. So in the end, I had to cancel my card, and I also found no way of actually reporting it as a fraudulent transaction. I could only ask to cancel my card.
So you weren't able to speak to a person who
Well,
could help you?
Not that I could find. No, and
I think Monzo would have been better with that, because I've had conversations with Monzo quite effectively and efficiently. So
I'll come to Monzo in a second. But when I think about my High Street Bank account, I had a similar thing a couple of years ago, and they actually called me up and said, "We found these suspicious transactions. Could you review them, please?" And I hadn't actually noticed them, and within 24 hours, they'd all been refunded. And that is a totally different quality of service to what you get on some of the digital apps at the moment. Example 2, returning to Monzo, is I was attracted by a notification I got from them recently where they said, "Have you considered moving your old pensions to Monzo?" So I thought I'd give it a go. They have a sort of pensions finding
Pensions
service
on Monzo is bold.
where they you share your details with them, and they go and retrieve the pension for you and bring it into the account.
those services I found in general, Pension Bee had one, and
Yeah.
I was not impressed at
Yeah,
all.
so I enter my details, and a few days later I get a notification saying, "Sorry, we haven't found a pension that matches those details." So then I think, okay, maybe I put the details in wrong. Let me do that again. Maybe I'll change the details or just make sure it's all correct. And the moment I do that, it says, "Sorry, we can't look for your pension twice." In other words, because I failed on first attempt, I'm now permanently banned from the pension section of Monzo.
I might start using that excuse at work. I'm sorry, I failed the first time.
Yeah,
I won't be attempting that
and
again.
you just think, like, if this happened with a high street bank, they would say, "Oh, maybe we got something wrong, or let's just double check these details," and they'd help you out.
It's strange also to nudge you to do it and then to say, actually, we don't really have the capability to host that on our platform.
And I just think the whole sort of one strike and you're out thing is like it's not nice customer service.
robotic.
It kind of feels like you're on the naughty step.
But the high street banks, the ye olde banks, they have much bigger infrastructure, right?
Yeah,
They have
yeah.
actual offices full of people, and they answer phones, and they look out for dodgy transactions. And
They even
stuff.
have some branches
But
left.
But you agree to that trade-off when you decide to get an app that is better, faster than anything of any of the high street banks. I find Monzo and Revolut to be infinitely better than almost any other high street bank app I can find. And for like 99% of the time, actually, I think you probably get a better service with a fintech bank rather than a ye olde one, because I don't have to go into a branch. I can pay.
Yes. Well, I think by and large that's true, but I think it's the risk element that concerns me a bit, which brings me on to my third and final example, where I tried to open an account with Moneybox a few days ago, and I filled in all my details on the app. All seemed to work fine for the first few days. And then the other day, suddenly I get this notification that I've been frozen out of my account. I can't get into it. I don't know why. And I get a message that says, "We require additional information from you. Please get in touch." Don't know what the information is or how I get in touch. I eventually find there's like a generic email you email, and then you submit details. I submit these, and they say, "We'll come back to you in 2 working days." So I'm frozen out of my account now for 72 hours. And you think that's fine because I've only had the account for a week or something. But if that were my primary bank account and I were on holiday or something, I'd be absolutely stranded. That's never happened to me in the 20-odd years I've had my high street bank account. I've never been frozen out and then someone saying, well, we'll think about coming back to you in a few days, whether we'll let you back in.
A risk of sounding like a Luddite. That's exactly why I only use a fintech bank for travel.
Well,
because the future terrifies me.
And
it sounds like you're experiencing some of the more dystopian edges of it.
The main observation I get from this is, actually, like me, most Brits now do have a digital bank account, but they don't use it as their primary account. So you look at the average deposit on like a Revolut or a Monzo, it's a few £100, whereas it's a few thousand or more on a high street bank. And I think until they can deal with those fringe cases as effectively as the high street banks, that they'll take a long time for them to catch up.
Well, I bank fully with Monzo, get all my money paid in there. I haven't won that monthly draw to double your money yet. But if anyone at Monzo is listening, happy to stick up for you again on this podcast.
Well,
anyway.
I'd love to have my pension with them, but they banned me. So there we go.
I hope their public affairs team only double down now.
Yeah.
Thank you very much, Simon. We'll make sure to book the CEOs of all those companies for you to interview one-to-one and not just be a keyboard warrior and actually stick it to them in person.
There we go.
Right. Thank you very much for listening to Business as Usual today, brought to you by Okta.
Don't forget to subscribe to City AM's daily and weekly newsletters, and of course, don't forget to download our free app.
We will be back in your podcast feeds tomorrow at 6 a.m, but for now, goodbye.
Goodbye.